Hey everyone, welcome to the KE Report and another daily editorial, this time chatting with Brien Lundin. Brien is the editor of the Gold Newsletter, also our host down at the New Orleans Investment Conference, happening this year, November 2nd through 5th. Now, Brien, we're going to talk a lot about what makes up the gold stock sector here. The big companies, there's actually technically less of the major miners out there. There's quite a few mid-tier miners that are showing some impressive growth. That's where we tend to see most of the growth in terms of actual production. And then there's a lot of development plays, defined resources, companies either looking for capital or might have some capital and are figuring out how they're going to potentially build their asset or get taken out. And then, of course, a lot of exploration plays. We've commented really over the last almost year now that it's been a market of the haves and have nots, where the haves continue to raise money and continue to advance their project. And those have nots, well, they haven't gotten much money coming in and they're not doing much. So, Brien, what is this environment that you're seeing out there where, again, that middle section, that developer and resource section, seems almost saturated now with so many companies having resources?
Yeah, it's interesting. Every metals bull market is unique in some respects, and there are unique aspects about this one that we need to know about. One is that, unlike previous bull markets, there's not as many majors out there ready to buy junior projects. There's been a lot of consolidation over the years, and the majors that are left at this moment in time are somewhat distracted. Newmont is still trying to digest the Newcrest assets that it got. Barrick is somewhat distracted by the situation in Mali, although as we speak, it reported tremendous blowout quarterly numbers today in terms of earnings and production, everything really, including reserves. But still, it's somewhat distracted. It's not really, as far as we can tell, out there shopping around. And as you mentioned, there's a lot of really good projects out there that are available for sale to the majors. Over the past, 5, 6, even 10 years of a somewhat sideways market, a lot of these companies with projects have been able to raise just enough, perhaps diluted their share structure more than they would have liked, but they've been able to advance these projects. And now there's a bunch of them out there, and they would be much better investments if there were, say, one third as many out there, but they're still there. And so, I guess it means it's a market where you really have to shop around and not just find good projects, but find great ones, find the ones that for one reason or another will be the first ones off the ones at the top of the list when the majors really start shopping.
Well, Brian, just to that point, I think what's happened is over the years, a lot of the drill plays of the past have had multiple seasons now, 3, 4, 5, 6 years of drilling to stack up. So they've got resources. Some of them have PEAs or PFSs. So now there's a lot of that middle ground development stage companies, either advanced explorers or developers. At this point, should some of them keep combining? Because we've seen a couple deals like with Stellar, you saw Moneta and Nighthawk combine, or with Next Gold, you saw Treasury Metals, Black Wolf Copper and Gold, and Signal Gold all combined. Should we see more of that where they're just massing up in size, or should people be more selective and just look for what has the best economics, the most recent studies? What are you looking at to filter through the noise?
Well, you want, yeah, best economics, but you also want projects that the majors are going to feel comfortable with, that are in good regimes, mining friendly areas, and that have checked off a lot of the boxes in terms of permitting, local relations, and environmental studies and the like, that not only eliminate some of the lead time for a major to get into production, but also an awful lot of the risk. And, there are some companies out there, and economics, of course, is important. The projects that can make money for the majors or even the mid tiers that buy them are the ones that are going to get picked up first.
What about jurisdiction then, Brien? What jurisdictions are you focused on? Which ones do you see as majors having more of a focus on in terms of wanting to acquire projects and build out a portfolio?
Yeah, I think the US and Canada remain the premier jurisdictions. I think the U.S. obviously is getting better and better when you look at the what is most likely going to be a much easier permitting environment in the U.S. under the Trump administration, like it was in the last Trump administration. In that regard, I think companies really need to move quickly, though, because those midterm elections can change things to some degree, not so much from executive policy standpoint, but it still can change things. So we've got a good couple of years ahead for permitting and advancing projects in the U.S., and even in some cases, getting government funding or support to advance projects, particularly in the critical minerals areas.
Brien, what are your thoughts on single asset developers or advanced explorers versus companies that have maybe 2, 3, 4 projects? There's some companies that claim to have 2 development projects or 3. There's some that actually have a producing asset that's small, but a larger development project. And there's some companies that just are a one-trick pony, but it's a good project. Any preferences there?
You have to take it on a case-by-case basis, but generally speaking, if you're in a junior explorer development group and you have more than one premier project, you really need to spin those out into separate entities so that they're daylighted, their potential is daylighted, and they can raise money to advance either one. That's really a great benefit to shareholders. It's one of those cases where diversification really doesn't help a company if they have more than one project that can sustain a company, or one big project that's getting all the attention and a bunch of other projects that are not getting attention. In those cases, they really do need to be spun out.
Well, Brien, I was thinking of a company that we both like Heliostar has producing assets, but it also has Ana Paula, which is a big development project, and it has other development projects waiting in the wing. Integra Resources done the same thing with Florida Canyon, and they've got Delamar and Nevada North. So what about that kind of a model where we're seeing more and more companies buy a producing asset with the idea to put that cash flow towards their big development project?
Yeah, and that's why I say you need to look at them on an individual basis. In those two cases, the projects are part of integrated plans where you can use production to fund the development of the next project and kind of stepping stone your way into, in Heliostar's case, a stated goal of becoming a mid-tier producer. And in Heliostar's case as well, if you look at their current corporate deck, they do a great job of showing how all of that development is staged over time and to get where they want to go, or a good way toward where they want to go. And I'm particularly impressed in their case with the plan and how it's all going to fall together.
So a little bit further down the food chain then, Brien, let's just circle back around to these companies with assets, resources in the ground. Million ounces just doesn't really carry the same weight it used to 10 years ago. Is there a certain size that you need to see a resource? Also considering the economics, but really just a baseline size minimum that you think moves the needle for a company and actually puts it in a true development play rather than just saying it's a development play, but quite frankly being a little small?
Yeah, I think that baseline of 1 million ounces is still where you are as far as a development play, unless you have something that's slightly below that, maybe 700,000 or 800,000 ounces and has really good grade. But that's more toward the mid tiers. The majors really want 5 million ounces or more. That's what they term as world class. That's what's going to get them the potential, very roughly speaking, of 500,000 ounces a year production over a 10-year mine life. That moves the needle for the majors. But beyond that, they want to see those boxes again checked off as far as the risk. They want to see permitting, environmental work, good governmental and local relations, and from a mining engineering standpoint, no fatal flaws in how to develop a project. There are a few of those projects out there today. I think Banyan Gold, which I own, as well as in Recommended Gold newsletter, is one of the premier ones out there.
Brien, what do you think about when you hear the term district scale? I think almost every company on the exchange puts district scale opportunity in their slide deck. Obviously, a major wants to see not just a project, but the ability for upside exploration, maybe finding satellite pits. How much work should a company do to prove out they really have a district scale? Is this just lip service? Is it important?
Well, it's interesting and it can be important, but a major is going to be able to read through the fluff pretty easily. If you have a large percentage of a large mineralized trend, then you're tempted at least to use the term district scale. If you have a massive land position surrounding your project, then you're tempted to use that term as well. So it's got a variety of meanings. There are companies out there that they have maybe 40,000 hectares or something like that, but they have a whole lot of a trend that I think they control a district, if not district scale. Generally speaking, again, I think that it's important for a junior to have some mystery left in the deal. They don't want their project, their resources to be fully circumscribed at any point. They want to show potential beyond what they've already proven to the market because a major, frankly, needs that. Unless a project's economics are extraordinarily good, they are greatly diminished by the very price that a major has to pay for the junior. So if a major comes in and has to pay $300-400 million to buy out a junior in its projects, that's essentially $300-400 million of capex that you added on to the development cost of that project. That is not factored into the economics of that project. A major looks at that. If you step into their shoes and look at that transaction, they're doing that because they see potential beyond what's already been outlined by the economics of what they're buying. So it is important to have a lot of land, a lot of established trend, a lot of potential left if you're putting your project on the auction block.
Let's move further down the food chain then into the explorers. There have been a couple really nice discoveries over the last few years, and those companies have been rewarded. There's unfortunately, which goes hand in hand with exploration, a lot of companies that have missed or quite frankly just say that they've hit a lot of smoke, which means that they hit some mineralization, but it's not carrying the grade or the widths that the market really jumps all over. So it warrants follow-up work, but the problem with that is that work also costs money, and well, the share price suffers because of the dilution on the back of that, and it's been quite difficult for these companies to raise money, and drill costs have gone up. So actually a lot going against exploration companies still, except for the fact that, look, one hole can change that whole story. So how are you viewing the exploration plays right now, which broadly are still struggling, but there's still a number of them that are completely outperforming the rest?
Yeah, well, exploration, of course, is where you can throw out all of the macro analysis, all the metals analysis, everything we've just been talking about. If a company has a big discovery, it can multiply its share price in a matter of a few hours once it makes that announcement. And we have seen that. We've seen that with A-Mark and their big discovery, which I think is tremendous. That was in Gold Newsletter's portfolio. Unfortunately, I didn't personally own it, but our readers have benefited greatly from that. Another company that made a great discovery just recently that's in Gold Newsletter portfolio is Aris Minerals that just had a tremendous 500-meter plus hit, copper porphyry hit in Kazakhstan. Now, its share price only went up, I think, about 70% or so, but that's nice in a day. I'll take that just about any day. So they are getting rewarded. Now, where they go from here, you have to look at these discoveries. There's a whole subsector of junior mining investors who don't bet on potential discoveries, but get in after a discovery and really analyze it, find their entry points, and say, well, I'm not going to get a 10 bagger, but if I can get a few 3 and 4 baggers, that's not bad either, with a lot of the risk put behind them. So both of those companies are early stage discoveries. And now's the point where investors need to look at those, try to get an idea of the upside potential, and then try and find the best entry point.
Well, Brian, you raised an interesting point. That's exactly what I was going to ask you about. There's the pre-discovery stories where you have the most potential upside, but also the most risk of not hitting. There's the post-discovery story where the discovery hole that's really animated the market's been made, but then there's usually a lot of upside left on the vine. And there's also the prospect generator model where they're trying to use other people's money on multiple projects to make discoveries, but they also only have partial interest. Of the three, which ones do you gravitate to the most, or is there any strategies you have around those three flavors?
Well, I gravitate to the pre-discovery because it's nothing like the adrenaline rush when a company you own makes a big discovery. And I've been fortunate to have that happen numerous times over my career. And it's great. It's wonderful. Great Bear was one of the biggest, and it's really exciting. But all three of those strategies have something to say for them. The thing I would say about Prospect Generator is that you are giving up some of your upside to get more tickets in the lottery, but it's very important how well those companies are run. In some cases, you have that model being used primarily to keep the management salaries paid and not necessarily make a big discovery. There are some companies like Kenorland that are just doing an incredible job with that strategy and are actually making money through the operating agreements that they have in management payments. So you do have to be selective in the prospect generators. I like to find companies that look at prospect generation as a business model and not a religion. That when they do come across a project that they can actually drill themselves to create a lot of discovery value very quickly, that they go ahead and seize that opportunity.
So, how do you analyze these companies then, Brien? What makes you get into a pre discovery play?
Well, you got to look at the work they've done, look at the exploration thesis, and see if the early work validates that thesis and really cuts the odds a bit. The odds are always against you, but if you can cut the odds a bit, then you've gone a long way. And by doing that, if you have a number of these pre-discovery plays where they've bettered the odds to some degree, then you have a better chance at hitting one of these 10 baggers or more. I like to look at the work on the ground. There are no guarantees in this business, but if you have, say, good geochemical targets that are bolstered by coincident geophysical targets, and you have it in an area where there are proven discoveries, if not already previous production or some sort, that really helps. There's a number of companies like that in our gold newsletter portfolio where, I've looked at the sniffs that they've turned up so far, and it seems like they're on the trail of something significant. Now, all that said, again, there's no guarantees in this business. There are great people doing wonderful things, doing everything the right way, and they still don't make a hit, still don't make a very significant discovery. There's just no guarantees. And there are people who are just god awful lucky. They raised just enough money for a drill program and they hit it on their last hole and they hit something they never anticipated. I was looking at a company last week that did just that and still don't know what they found fully, but they found something very significant. And so there's a good bit of luck involved as well.
Yeah, Brien, there absolutely is. I think some of the big stories we've seen over the last couple of years, some of them have been lucky hits or they found mineralization in a completely different metal that they weren't even looking for. And then that
Yeah.
became the story. But when you're looking at a pre-discovery story and you're betting on the jockey and you're betting on the geophysics and the targeting, do you also look at things like how tight the share structure is or what kind of a budget are they working with? What's terrible is when you see a company that was maybe one hole over from what could have been a discovery, but they ran out of money. So is there a certain amount of treasury you want to see behind a pre-discovery story?
Yeah, that's an important consideration, of course. The structure is something that's vitally important. And unfortunately, after years of this market, again, like haves and have nots, where it's been really tough to raise money on good terms, if you can raise money at all, a lot of share structures have gotten blown out for companies. And they face this situation where they've got a great target and they can raise just enough money to drill it, but they can only afford one shot at it and maybe only 3, 4, or 5 holes on this target. And that's it. And then they have no more money. And then, they should consider the joint venture route, but then the majors aren't really interested in because there's just so many interesting targets out there. it's a predicament for these companies to in that kind of a situation, because one hole can make a discovery, but two holes can kill one. If you put two holes and that's all you can afford into a target, which doesn't, most targets are not justified with two holes, don't justify going after them. If you miss on those two holes, and then you could kill that target, could kill your company, when that third hole or that fourth hole or that 10th hole would have hit it. So it's a fine line, and there are a lot of companies out there that are on that fine line. And investors need to realize that, you don't want to bet on a company that's going to push all of its chips into the middle of the table on one shot. It just rarely works out.
It's true, but unfortunately, sometimes these companies just don't have a choice because of how hard it is to raise money and also because of how expensive it has been to raise that money and drill. Brien, final comment then, I guess portfolio management wise, if you're playing a lot of these early stage explorers, how much do you spread your bets? How much do you concentrate on select companies?
One of those situations where I do as I say and not as I do, because I tend to spread my bets too widely and really do need to rationalize my portfolio. But I think what you want to do is look at your portfolio and gauge which ones have the best upside potential with lowest relative risk versus the other ones in your portfolio. And even staying within your portfolio, you may want to take some of those companies, sell them, and put the cash into the ones that you think are better and try to focus more on those. It's always tough in this market because you never know where the next big discovery or takeout is going to come from. But with all the factors that we've been discussing, you can narrow your odds, and diversifying among the better companies gives you more shots and more tickets in the lottery.
All right, Brien. Great having you on the show again. Brien Lundin is the editor of the Gold Newsletter and our host down at the New Orleans Investment Conference. Click the link in the show notes to follow along with the Gold Newsletter and find out what other stocks Brien is recommending. Brien, great chatting with you. We'll chat again in a couple weeks.
Thanks, guys. Good talking with you.